And then the first item should be pre-tax accounting income, right? Which is the 14 millions, right? And then you have the differences, right? The only one difference is the so-called the warranty cost, right? The warranty cost, okay? You remember warranty cost, right? Warranty cost make what? What happened with warranty cost? You recognize at the end of 2021, you predict, right? So we make a prediction what will be the total warranty cost, okay? And then you recognize the warranty expenses at the end of 2021, okay? But you're not allowed to deduct in the tax returns, okay? So that's why taxable income is greater than accounting income. Is that right? Okay, that's why you can see taxable income is 20, accounting income is 14. Okay, that the difference is 6. 6 is warranty. Was warranty expense. Okay, recognized in 2021. Okay, so if you look at temporary differences, so you start with 14, right? So you have 14, you subtract that's 6, right? So that's you got pre-tax accounting income should be 20. Okay, that's a 20. And then 20 times this year's tax rate is what? 25%, right? You can see 25% is a current year tax rate. So you time 25%, that will be income tax payable, right? That's the one item in the journals. And then you need to calculate the future deductible amounts. You know the total future deductible amount is 6, right? Okay, you paid more tax, so that's why you have future deductible amounts. So totally it's 6, and then this is the detail, right? Details. Okay, so you have to, because the tax rate is different. See, tax rate different. That's why you have to calculate year by year. What's the total tax benefits? Right? You calculate total tax benefits. Okay.
Professor, we can't hear you.
Oh, hello. Can you hear me?
Yeah.
Yeah. Okay. Yeah. So you're done?
Yes.
Okay. Okay. Um, so let's go with this question. Okay. Go with this question. Let me erase this part. Okay. As we talk about, so current year is 2021, right? 2021. So pre-tax accounting income is 14, right? 14 here. And then we know the taxable income is 20. So the difference is 6. 6 is because of the warranty expense, right? So 6 is warranty expenses for this year. Okay, so warranty expenses, we recognize that in the year 2021 in accounting, right? But we're not allowed to deduct in the tax return. So that tells us we need to pay more taxes, right, in the current year. So that's why taxable income is 20, accounting income is only 14. Okay, so we paid more taxes this year, so the future we can deduct, right? So the total future amount is 6. Okay, it's a total future deductible amount is 6. Okay, and then this is the detail, right? So those are 4 years. Okay, how we gonna deduct, right? Gonna deduct 2 million in 2022, 3 million, and 1 million in 2023, etc. Okay, and then we have these are tax rate, right? Those tax rate for we predict the tax rate for those 4 years. Okay, so then what will be our tax benefits? You need to times, right? So those are the tax, those are deductible amounts, right? So you deduct 2 millions, you times 20%, you got the 0.4, right? Okay, so 1 million you times 20%, you got 0.2, right? So you add, okay, so you calculate, then you add total here is what? Is 1.1, right? 1.1 should be what? Should be the total deferred tax assets. Okay, so deferred tax assets should be 1.1. Okay, let's say the beginning balance 0. Okay, so how to make it become 1.1? We need to debit 1.1. Okay, that's why this is the journal here is you want to calculate 20 times 25%, right? Which is tax rate. 20 times 25%, you got 5, right? 5 is the income tax payable. So we credit 5 to income tax payable, and you debit 11 to the deferred tax assets. And the last item is the income tax expense, right? So which is to the balance, 3.9. Okay, so let me share the screen. Where's that? Okay, you see this screen?
Yes.
Okay, that's great. So 17. Let me see, where's the 17? Yeah, let me share the solution screen so you can see this is the formal solution. What? What? What come? I'm having problem with this. Yeah, sorry, I have a problem with this PDF file. Let me just go back to that. Let me do that share again. No, it's just something wrong. Sorry about that. Something's wrong with that. So yeah, it's to fix that solution. So I just want to show you the formal one, but the one that's just like the example we had, right? So we have you could set up a separate column. The first column should be the current year column, right? So this is the current year column. Okay, this is the current year column. Okay, 2021. Okay, and then so then this is detailed is the calculation of the future deductible amounts, right? So that's how we get 1.1, and the journal will be debit 1.1, right, to the deferred tax assets, credit income tax payable for 5, right, for 5 here, okay, and the debit income tax expenses for 3.9. So that's the journal. Everyone's okay with that?
Yes.
Okay. You guys okay, right? So then the question number 2 is, what is the company's 2021's net income, right? So what is the net income this year? Okay, So you already figured out the income tax expense is 3.9, right? Okay, so that based on the journals. So pre-tax accounting income is 14, right? So then 14 minus 3.9. So we got 10.1. So that should be our net income this year. I looked okay, everyone, about tax rate. You can see the different tax rate. Then you want to calculate your tax liability or tax benefit, using those different tax rate. Any question at this moment? Okay, if not, let's go back to the PowerPoints. Okay, so that was the second issue. Okay, the first issue was the permanent difference, right? So we have permanent difference. It's easier to deal with that, right? And the second issue, what if we have different tax rate? Okay, so then this is third issues. Okay, third issue. So we said we have multiple differences. Okay, multiple differences. What are we gonna do? So this is a normal situation. In reality, company usually have multiple differences. Okay, what are we gonna do? So you want to separate. First thing, you're gonna separate the permanent versus the temporary, right? Permanent is always a permanent. Okay, you don't have to consider any future the taxable amount of future deductible amounts. Okay, so it's permanent, and then you want to look at these temporary differences. So you want to examine those temporary one by one, but then put categorize. Okay, so those temporary differences result future taxable amount. You put it together, and those temporary differences result going to result the future deductible amount. You also going to put it together, okay? And then you could treat it as a two group, right? Two group, and then you gonna just do what we just learned, okay? What we learned. So let me show you this example. Okay, so 2016, this is the first year, okay, for this company. We reported pre-tax accounting income is 200, which include the following amounts. Okay, so pre-tax accounting income is 200. Okay, for this year. So this is what we have. Okay, so we have income from installment sales. Okay, of 9 millions. Okay, this is 9 millions. It's installment sales. Will be reported for tax purposes. Okay, in 2017 and 2018. So what is, remember that's got the installment sales. When we have installment sales, we recognize that as sales revenue. Okay, and then but we're gonna pay tax in later, right? So that's why in this case, what do you see here? This is the pre-tax accounting income. Pre-tax accounting income is higher than the taxable income, right? Okay, so accounting income is higher than the taxable income. Okay, so in this case, what do you see here? Well, that's the first situation. You're gonna see the future taxable amounts, right? Which is you're gonna see deferred tax liabilities. Okay, right? So that's the first one. Okay, second differences. Okay, you can see we have several differences here. Second difference is the depreciation. Okay, so depreciation is reported by the straight line method on the assets with 4-year useful life. Okay, this asset is a 4-year useful life. Okay, so then on the tax return, we use the straight line method. Okay, so in accounting, tax return deduction for depreciation will be more than straight line depreciation in the first 2 years, but less depreciation expense for the next 2 years. You can see this tax rate is here, right? So for the first 2 years, you're going to recognize more. Okay, this is tax depreciation rate is more likely. We call that accelerated method. Accelerated method. You remember that, right? We talked about those in 121A. But tax method is a special method. Okay, so so in this case, we reckon the first 2 years you can recognize more than 50. Okay, 50 is what? Those are 50, right? So total is 200, right? The depreciable assets. each year depreciation is going to be 50. Okay, so if this is the accounting, right? This is the accounting. Okay, so we recognize the equally. Okay, every year the same amounts, but tax returns in the tax code allow us to recognize more in the early 2 years, and those, of course, the last 2 years, you're going to recognize less because no matter what, total is 200, right? So this is the differences. Okay, so accounting and tax. And then if you look at the first year, the difference is 16, right? 16 is the difference, okay, between 50 and 60s. In this case, what happens to that difference is 16? In this case, what kind of situation? Remember, this is the situation you recognize more deduction in tax in the first year, right? That makes the taxable income is less than accounting income, pre-tax accounting income. Is that right? Because you deduct more tax, more deductions, okay, in the tax code, tax returns. So accounting income is greater than taxable income. So that results is what? Future, some part of will be taxed in the future, right? Future taxable amounts. Okay. And then we're going to result the deferred tax liabilities. So the first two situations both are all deferred tax liability issues, right? So that's the first two situation. And number three situation, the differences, okay? Estimated warranty expense will be deductible on the tax return when actually paid during the next 2 years, okay? So this is warranty expense. Remember warranty expense, okay? So warranty expense is 7, okay? We recognize in the year 2016, okay, warranty expense, but you're not allowed to deduct in your tax returns. Okay, so you subtract, right? You subtract the warranty expense to get your pre-tax accounting income, but the tax return is not allowed to subtract. Okay, that makes what? That makes tax returns higher, right? Tax return. This is number three situation. The tax return, taxable income is higher than pre-tax accounting income, right? It's higher than that. So accounting income is less than taxable income. So we relatively paid more taxes. In the future, we can deduct, right? So we call it future deductible amounts. So that's why we have a future benefit, right? Future, we're going to have a tax benefit. We're going to save our tax. So this is the deferred tax assets situation. Okay. So this is the situation number 3. So let's say, so this is, it was 2016, right? So now how about 2017? Okay. 2017, let's leave it there. Okay, so let's work on 2016 first. Okay, and then we're gonna talk about 2017. So 2016, so this is pre-tax accounting was 200, right? 200, and then we have those differences. Okay, so installment sales, depreciation, we have warranty, right? Those are 3 different temporary differences. Okay, we already know the first 2 are the deferred tax liability situation, and the warranty expenses deferred tax assets. Okay, so so those are the differences. Okay, the differences. So installment sales and depreciation. Okay, installment sale depreciation. So those 2 situations, pre-tax accounting income is higher than taxable income. So want to calculate taxable income, you need to subtract, right, from that 200. Okay, and the warranty expenses is the situation taxable income is higher than a pre-tax accounting income, right? To calculate taxable income, you need to add. Okay, so that's why we have this taxable income is 182. 182. Okay, so once we got 182, then we know the current year tax rate is 40%. 182 times 40%, you got 72.8. So you need to credit income tax payable 72.8. Okay, for this year 2016. Okay. And the future taxable means or future taxable amount or future deductible amounts, right? So you can see those first two, you're gonna have future taxable amounts, right? This one. Okay. So those are the future taxable amounts. Okay, for the first two. And the third one here, we have future deductible amounts. Okay, because for third one, you have relatively paid more tax right now. Okay. So you group them together, right? So for those two, 1 and 2, you group them together. So the total future taxable amount is 25. Okay, total future taxable amount 25. And also, the number 3 difference is only 1. We only have 1, right? So the total future deductible amount is 7. Okay. So now you times 40%, you got the 10 for the, because this is 25 is the future taxable amount, so 10 should be deferred tax liability, right? So now look at the future deductible amount, 7 times 40%, you got 2.8. 2.8 should be deferred tax assets. Okay, let's assume initial balance are all 0, right? Because this is the first year. So then you should write a journal. So now we know, right? So we know these two, we need to credit 10 to the deferred tax liability, debit 2.8 to the deferred tax assets. Okay, so that's the journal, right? You debit 2.8, you credit 10, right? And then the last item always the income tax expenses is the balance. Okay. So this is 2016. And this is multiple differences, right? So what we're going to do is you want to analyze one by one, and then you group, right? You group those, like a deferred tax assets together and deferred tax liability together. Okay, you calculate the total future taxable amounts and total future deductible amounts. Okay. Looks good. 2016. And how about 2017? So, yeah, so you see that's because we have multiple, so that's why it's make it a little harder, right? As you can see, we have a lot of situations.
I have a question.
Oh, yeah, go ahead.
So the deferred tax asset and the deferred tax liability are two separate things.
Yeah, you want to separate, yes.
Okay.
That's why you want to separate, yeah. So then
Is there any problem if you put it in one chart?
no, you separate. You can see that's why we separate. You can calculate separately, right? So this is the let me raise the one. Okay, this is the deferred taxable amounts, right? And then this is the future. This is the future taxable amounts. This is the future. Okay, this is the future taxable amounts. This is the future deductible amounts. Okay, see, you separate those one. You calculate separately, and then when you write a journal, you're also going to be separate, right? So you can see we put, to look at the bottom, the journal, you debit. In this case, we debit deferred tax assets, we credit deferred tax liability. Okay, so you treat it separately, but when you
Yeah.
write a journal, of course, you put it together.
Okay, so in the balance sheet, can I put them together and see how much liability or
No, you don't calculate, you don't put those two together. Balance sheet, you're gonna report separately. You're gonna report the deferred tax asset as one of the assets, and you're gonna report deferred tax liability as one of the liabilities.
Okay.
Okay, you report separately.
If you want to see the difference, can you, for example, subtract 10 from 2.8?
No, not really.
Okay. Thank
Yeah,
you.
you don't need to see the differences between these two. Okay, it will be treated separately. Okay. So this is 2016, and then how about 2008?
I have a question.
Next, yeah, go ahead.
So you subtract the 80 from the 200 pre-tax income to get net income?
Subtract 80. which slide you're talking about?
Subtract
Yes, exactly. Yeah. So 80 is the total income tax expenses. Yes. You pre-tax income is 200, right? You subtract that 80. Yeah. So 120 should be the net income. Yes.
Got
Okay. So now let's take a look 2017, right? Next year, what are we gonna do? Okay. So remember next year gonna be reversal, right? So next year, then we add one more thing here. We said, in this pre-tax accounting income, still 200. Okay, so 200 again. Okay, for 2017, but now we have a loss. Okay, we have another item here. Okay, so we have estimated loss from a accrued loss contingency. Okay, so the loss expected to be paid in 2019, the time it will be tax deductible. Okay, so remember this loss, this is a new one, right? We haven't talked about this loss yet. The loss, this is the loss contingency is what? It's our predicted loss. So this is the end of 2017, we predict, so we're gonna have this $1 million loss. So that's why in accounting, we subtract, right? So $1 million is one of the expense. Okay, it's treated as a loss. But again, tax law most likely a cash basis, right? So they won't allow us to deduct. Okay, they won't allow us to deduct. That's in that case. That's why our accounting income you already subtract, right? Accounting income you can subtract that, but tax code is not allow us to subtract. That's why taxable income will be greater than accounting income, right? Accounting, because accounting we subtract 1 million, but taxable income you cannot subtract. Okay, so that's another temporary difference. You only be able to subtract is what when 2019, right? You can deduct it. Okay, in the tax return. Okay, so this is what this is the deferred tax asset situation, right? This is the deferred tax assets. Okay. Situation, right? Because we have future deductible amounts, then you have deferred tax assets. That makes sense, everyone, about this situation? Okay. So we need to deduct from accounting income, right? But you cannot deduct from taxable income. That's why relatively we paid more tax, right, in the current year, 2017. So let's go to 2017. So what happens, let's say pre-tax accounting income is 200, and now for the installment sales, remember now you actually collect, right? We collect 5 million. Now we need to pay tax now. Okay, and depreciation, the difference is further increase, right? So now the total differences become that 54, right? So this year that increased by 36. So total differences now become 54. Okay, remember the first 2 years you accelerated, right? So accelerated method. Okay, so the difference even increased in the second year. Okay, for depreciation. So so how about the warranty expense? Warranty expenses happened. Remember that 7 is the predict, right, for warranty. Now you actually incurred gonna be 4, right? So now you can deduct 4. So our total you can deduct 4 right now, right? So our total future deductible amount now becomes 3. Okay, it was 7. Okay. So then we have one more, right? So those are estimated loss. Okay, so that's loss contingency. Should be it's $1 million, right? $1 million you want to you need to recognize because because this is what the taxable income is higher than accounting income because tax code not allowed to deduct, right? Accounting income is subtract. So that's why taxable income is higher than accounting income. That's why you plus 1, right, to get taxable income. Okay, but then you have a future deductible amount. It's 1. Okay, you can deduct in 2019. So then the first thing you're gonna do, you want to calculate what's the total taxable income, right? Taxable income. So plus minus this column, right? You got 164 is the taxable income. And then you also calculate what's the future taxable amounts, total, what is the total future deductible amount. Okay, so then you times the tax rate, right? So let's say tax rate of everything is 40%. So this time, so 164 times 40% equals 65.6. That should be the income tax payable, right? So then this gonna be deferred tax liability, the balance in that account, and then this 1.6 should be the balance in the deferred tax asset accounts. So then we know the balance, right? So deferred tax liability account should be this. How to make it become this? You need to credit, right? How about deferred tax asset should be 1.6? How to make it? You need to credit 1.2. Okay, so that's why we have these journals, right? You credit deferred tax assets, you credit deferred tax liability, you credit income tax payable, and the last item is income tax expense. It's a total in this case. That makes sense, everyone? You know, when we have multiple temporary differences, you just separate, right? So you just analyze one by one, and then you group, right? Group those future taxable amount together, group those future deductible amount together, okay? And then you calculate, right, the balance of the deferred tax liability and deferred tax assets, okay? And then you write the journals like this.
I have a question.
Yes.
Why don't you debit the deferred tax asset?
Debit deferred tax asset?
You credit during end of 2017.
Yeah, because initial balance was 2.8. Remember, this one comes from the previous year, 2016.
Okay.
Yeah, but now based on this, you know, it should be 1.6, right? You know, based on that total future deductible amounts times the tax rate. So it should be 1.6. So how to make it become 1.6? That's why you need to credit 1.2 to make it become 1.6. You need to credit. That makes sense, everyone? Any other questions? Any question at this moment? Yeah, we don't have time to let you practice in one of the homework questions, but make sure you do homework questions, okay? Do the homework questions, and you check with solutions online. Okay. So those are the three topics. Basically, we already done with the basic, right? In the two lecture. Okay, we're done with the basic situation, the temporary differences. And then today we talk about those three topics. One is to talk about the permanent difference, right? Permanent difference is very straightforward, right? It's just gonna different. It's different permanently. Okay, you're either gonna subtract or add, right, to get the taxable income, and then the difference gonna stay forever. Okay, you don't have any future taxable amount or future deductible amounts. Okay, on those permanent differences. Okay. And the second issue is we talk about what if we have different tax rate, right? So then we use, for the different tax rate for the different years, okay, to calculate those deferred tax liability, deferred tax assets. And the third issue here, what if we have multiple, right? So you group those, you analyze one by one, but then you group those as, if these belong to the future taxable amounts or belong to the future deductible amounts, okay? You group them together, okay? And then you apply the method. Okay, so those are three topics. So we have, I think we have just one more topic, and next time. Okay, so then we're done with this. So we have a spring break, right? So so you can have a spring break, take a break, but just remember we have an Excel project going to be due on Monday, right after spring break. Okay. I post the information on Canvas. So make sure once you have your Excel file, you just upload it to Canvas. Okay. If you have questions, you can, some people already asked me the question during my office hours. If you have questions, you can ask me during the Mondays, I mean next week, right? So Mondays office hours. Okay. I guess that's the time. So that's all for today. So you guys have a nice spring break. Okay. Just relax.
Okay.
You too,
Okay.
Professor.
Yeah.
Professor,
Yes.
I have a question. For
Yes.
the exam coming up, do you have any review sessions before the test?
No, we don't review because the exam is gonna be on those two chapters, as I told everyone, right? So we're gonna have like a multiple choice questions. Okay, will be conducted through Canvas. Okay, and I will talk about that on the Monday. Okay, so will be
Okay.
multiple choice questions. Okay.
Multiple choice question. Okay.
Yeah, gonna
got
be
it.
conducted during the class time.
Okay. Thank you,
Okay.
Professor.
You're welcome. Okay, take care, guys.
Bye.
Okay.
Bye bye.
Thank you.
You're welcome.